All right, we've just come out of the tunnel. Halftime is over. We've made some adjustments. We'll see what we've got going on now for the second half of the game here. Let's take a look and see what we've got going on with the markets and your money. Let's bring up corn and see where we stand. And we're about where we were. Maybe we've come back a half a cent at the most, but we're still lower. 6 3/4 cents lower in that March contract March corn to 4.24 1/4, a penny and a quarter off the low of the day. We've had an 8-cent range. So for a penny and a quarter off the low of an 8-cent range, that kind of paints the picture. You don't need to know much else, right? 5 3/4 cents lower in that D's contract to 4.64. We've had about a 6.5 cent range too. So that'll let you know we're about a half cent off the low of a 6.5 cent range. That's trading weak. We're off across the board between 5 3/4 and 6 3/4 cents when we talk about corn. Let's go to the beans. It's off about a nickel to 6 cents. There you go. 5 1/4 cents lower in March. 11.81 even is last. I pick out July. That's the one I want to go to. That's down 6 cents to 11.95 and a half. The good news is we're 4 1/4 cents off the low of the day. Bad news is $12 is in the rearview mirror. We were up at 12.03 1/4 earlier. Couldn't hold on. 11.95 and a half is last there. That's down 6. That's beans. Let's go to Chicago wheat and see what that's got for us. 12 3/4 cents lower in the March contract to 5.84 3/4. And that's getting hurt. 11 3/4 cents lower in the July to 5.86. That's 2.5 cents off the low there too. I guess you could say we've had decent ranges by about 14.5 cents. So for 2.5 cents off the low of a 14.5 cent range, and you got to get the picture. Let's go to the hard red wheat in Kansas City. From Chicago to Kansas City we go. 8 cents lower in that March contract to 5.86 and a half, and we're 8 1/4 cents lower in the July to 5.77 and a half, right? All right, spring wheat. Let's take a look at what we've got in Minneapolis. 8 1/4 cents lower in the spring wheat. That's March. 6.63 and a half is last there. 2.5 cents off the low of a 10 3/4 cent range. 8 1/4 cents lower in the July to 6.69 3/4, and that's 2.5 cents off the lows there as well. Spring wheat in Minneapolis suffering the same fate as Chicago and Kansas City. How about cotton? This is one of the better ones. 148 points higher in that front month March. We're up at 93 even, 98 points off the high, and about 109 points off the low. And we've got a 189 point rally in the May right behind it to 93, 95. Doing pretty well there. That's not bad. That's a good cotton board. And that also is a great segue into my next guest analyst, Riley Schwieger. He's with CHS. I think he's up in Timber Grove Heights at the home office there, the big satellite where they train them up and send them off on their way. All right, Riley, what do you got for us today?
Yeah, down day in the energy complex. Really started the week wanting to move higher to continue last week's gains, but we were met quickly with that hawkish CPI print. Obviously, if we're going to see stickier inflation and the Fed is incentivized to hold interest rates higher for longer, that's a pretty bearish dynamic for energy demand. We did see an EIA report today as well. That was also pretty bearish. We saw a much larger than expected build in crude stocks of 12 million barrels. One key thing in this report is it did include an unexpected outage at the BP's Whiting, Indiana refinery, one of the largest inland refineries here in the U.S. So very, very significant, especially for Midwest supplies. We did see crude production steady at record levels, 12.3 million barrels per day. Refinery utilization taking a hit, falling to 2022 lows there. We're expecting a big turnaround season. Some of these unplanned outages are really going to support the idea that these crude stocks could continue to build. Products on the other side of the dynamic here, diesel is off 1.9. Had 2 stocks remain at 5-year highs despite the outage, so pretty resilient there. Part of that's probably due to the 4-week average demand for diesel falling to its lowest level since 2016. Hoping that manufacturing can turn the corner here to kind of help support diesel demand, but we just haven't quite seen that yet. Gasoline took more of the brunt from the refinery outage, off 3.6 million barrels. Had 2 stocks here in the Midwest, fell 2.5 million barrels. Demand did decline 7% last week, but more resilient than diesel demand overall, trending similar to last year's levels. I do think that the storms over on the West Coast are certainly pressuring demand lower here this week. Just collectively, crude, gas, and diesel all below 5-year average levels from an inventory perspective. That's pretty important for a lot of these geopolitical factors to kind of pressure this market higher, seeing some of these outages or disruptions become real in the marketplace. And then just really quickly to touch on natural gas, very, very bearish natural gas market. Futures have fallen to 3.5-year lows. We've seen production really strong, and obviously haven't brought a coat to work here in about 2 to 3 weeks here in Minnesota. So very, very warm weather continuing for the next couple weeks is what the forecast is telling us, allowing these prices to really plummet. So overall, a very bearish day for energies.
All right. Well, I appreciate that, even though it is bearish. We'll have to wait and see, but great stuff as usual. Good content. Thank you very much, Riley Schwieger. He's with CHS up in Inver Grove Heights. We're going to go away. We're going to pay some bills, and I'm going to come back and talk to you about livestock. Some of them furry, some of them not so furry, all four-legged. We'll be right back.